The national debt of the United States has exceeded $30 trillion.
The national debt now tops $31 trillion.
America has hit its debt limit, surpassing its $31.4 trillion debt cap.
$32 trillion.
We're talking about $33 trillion in national debt.
In this video, let's talk about what the heck is going on with the unresolved government shutdown, the massive US budget deficit, the unsustainable debt levels, and how all of this is going to have a trickle-down effect in the global economy, specifically for the emerging countries around the world. By now, we all know that the United States government loves to teeter on the edge of disaster. At the 11th hour, the US agreed to a spending deal that temporarily keeps the US government open for the next 45 days, and then we get to go through all of this over again. Now, there's a few problems with this. For one, the optics are pretty terrible. The United States is supposed to act as a leader on the world stage. However, the government has become obsessed with politicizing everything. But as bad as that is, it's not even the most significant. Just like how individuals have credit scores, countries have credit ratings, and these ratings represent the government's ability to repay its debts. The highest grade possible is a AAA, meaning it has the lowest risk and most likely to repay its debts. There are three main credit rating agencies: Standard & Poor's, Moody's, and Fitch. The United States used to have a AAA rating with all three of them, but in 2011, Standard & Poor's downgraded the United States from AAA to AA+ when the government flirted with their own self-imposed deadline to agree on a new debt ceiling, holding the entire US economy as hostage. S&P cited concerns about the government's budget deficit and rising debt burden. Now, if that sounds familiar, that's because it happened again earlier this year. The US government squabbled back and forth about the debt ceiling, got way too close to their self-imposed deadline again, and got downgraded again, this time by Fitch. Fitch had a tougher tone with their reasoning by saying there was a steady deterioration in standards of governance over the last 20 years, including on fiscal and debt matters. They went on to say the repeated debt limit political standoff and last-minute resolutions have eroded confidence in fiscal management. Based on these comments from the two credit agencies, it is very clear that they prefer transparency and timely deliberation on fiscal matters. So surely the United States learned their lesson this time. Right? Well, surprise, surprise, a US budget crisis down to the wire of a self-imposed deadline again that had the government on the brink of a shutdown, and you better believe the third and final credit ratings company, Moody's, where the US still holds a AAA rating, has been keeping a close eye. They even threatened the United States' current AAA rating by saying, while government debt service payments would not be impacted and a short-lived shutdown would be unlikely to disrupt the economy, it would underscore the weakness of US institutional and governance strength relative to other AAA-rated sovereigns that we have highlighted in recent years. While the government kicked the can down the road again, they aren't out of the woods yet, and I imagine if they try to get too cute again after the 45 days, they're going to easily lose another AAA rating. And this is significant because as the credit rating goes down, that makes it slightly harder and more expensive to do business going forward. Interest rates will go up, specifically for government bonds, which is the tool the US and other countries use to help fund their country. Rising interest rates and US government bonds are especially important to the rest of the world, which we'll get to in a second, but if you like videos like this that talk about the impact the United States has on the rest of the world, and you want to see more of them, make sure to subscribe to the channel. The CEO of the world's largest bank, JP Chase, thinks the Federal Reserve will continue interest rate hikes all the way up from the current rate of 5.5% to 7%, saying, I'm not sure if the world's prepared for 7%. Now, this is a bit of speculation on his part, as the Federal Reserve stated themselves they are only expecting one more rate hike this year before rate cuts next year. So the chance, according to the Fed, of going up to 6% is unlikely, let alone 7%, but it just speaks to where some people think the market is going. And if we couple that with a recent article by Bloomberg saying that the dollar emerges as the best safe haven during US shutdown fears, the rest of the world could feel the pain the most. If you're sitting there asking, how does that make any sense at all? I agree, but let's dive into it. The standard move for people during periods of financial stress is to go to the dollar. And this is the power that the world reserve currency has, even if the periods of stress are caused by the United States. The global meltdown will start with the US dollar strengthening and taking down global economies, especially the emerging markets. This is happening right now as we speak, as global currencies, even gold, are all dropping as investors are running to the dollar. If we look at the last 6 months, the major currencies in the world are all down against the dollar. The euro, the yuan, and pound are all down, while the yen is getting crushed. And the dollar is actually at its highest point against rival currencies over the last 10 months. Financial stress will put pressure on a fragile global system, and higher interest rates create a gap between the United States and other countries that money will start to flow back into the dollar. It makes imports to countries with currencies weakening against the dollar, like Japan, very expensive. And while rising interest rates in the United States slow down borrowing, it creates a large inflation problem around the world. In each of those situations, consumers, people like you and me, are forced to spend less money, which causes global consumption to fall, bringing the world much closer to a recession. And since the United States has the world reserve currency and is the top economy in the world, their success and their failure have huge implications around the world. Find out how the dollar has recently caused a global recession in this video here.